Introduction to Treasury, Maturity Transformation. Lending and deposit-taking institutions, LDTIs, have a significant impact on the global economy. These institutions, including commercial banks, savings banks, and credit unions, play a vital role in shaping the distribution and availability of financial resources. One of their key functions is transforming short-term customer deposits into long-term loans, a process known as maturity transformation. The process of maturity transformation. LDTIs collect short-term deposits from customers with surplus funds and lend these funds to those in need for longer periods. This enables the institutions to earn returns in the form of interest while fueling economic growth. Understanding the role of LDTIs. Facilitating economic growth. LDTIs enhance economic growth by providing funds to entities in need of capital for investment and operational purposes. This accessibility of finance encourages businesses to invest in new projects and consumers to spend, driving economic activity and growth. Risk management. LDTIs manage risk through diversification by lending to a diverse set of customers. By spreading loans across multiple borrowers and sectors, they mitigate the potential impact of default by a single borrower or sector. This approach promotes stability and acts as a safety net for the overall economy. Creating a savings-investment link. LDTIs bridge the gap between savers and borrowers, channeling funds from those with surplus money to those in need of investment capital. This connection between saving and investment activities fosters financial stability and growth. Providing liquidity. Despite the risks involved, maturity transformation allows LDTIs to provide liquidity to the economy. They accommodate the liquidity preferences of depositors while supplying long-term loans to borrowers. Monetization. LDTIs contribute to the monetization of economic activities by creating credit through lending. This expands the money supply in the economy, facilitating commerce and industry and enabling efficient transactions. Conclusion. LDTIs serve as engines of growth, risk managers, and facilitators of monetary transactions. Through the transformation of short-term deposits into long-term loans, these institutions earn returns while driving economic growth and stability. Their crucial role in the economy cannot be understated, benefiting both commercial and individual endeavors. Want to learn more? Claire Trithel on LinkedIn. Introduction to Treasury, Investment Banks versus Retail Banks. As banking professionals, it is crucial for us to understand the intricate workings of the financial world. In this discourse, we will explore the economic roles of investment banks and retail banks, highlighting their differences and unique contributions to our economy. The role of investment banks. Investment banks serve as vital intermediaries in financial markets, connecting issuers of securities with investors. They offer a wide range of services that play a critical role in our economy. Underwriting new securities. Investment banks play a fundamental role in bringing new securities to market. Mergers and acquisitions. Investment banks provide advice on mergers and acquisitions, acting as strategic consultants in business deals. Proprietary trading and market making. Investment banks engage in proprietary trading by trading securities on their own account. Research. Investment banks conduct detailed research on various sectors of the economy and individual companies. The role of retail banks. Retail banks primarily serve individuals and small businesses, providing essential financial services and facilitating economic activity. Deposits and loans. Retail banks accept deposits from customers and lend out these funds in the form of mortgages, personal loans, and business loans. Payments and transactions. Retail banks offer secure and efficient means for individuals and businesses to make payments and transfer funds. This is crucial for the smooth functioning of the economy. Savings and investments. Retail banks provide a range of savings and investment products, helping individuals grow their wealth and plan for retirement. Financial advice. Retail banks offer personalized financial advice to individuals and small businesses, assisting them in managing their finances and making informed decisions. Distinguishing between investment and retail banks. While investment banks and retail banks both play integral roles in the economy, they have substantial differences in their customer bases, services offered, and risk profiles. Customer base. Retail banks primarily serve individuals and small businesses, while investment banks typically work with institutional clients and high-net-worth individuals. Services offered. Retail banks focus on accepting deposits, providing loans, and facilitating payments. Risk profile. The activities of investment banks generally carry a higher degree of risk compared to retail banks. This is due to their exposure to complex financial instruments and volatile markets. In conclusion, both retail and investment banks play distinctive and vital roles in our economy. Conclusion. In conclusion, both retail and investment banks play distinctive and vital roles in our economy. Retail banks channel savings into productive investment and facilitate everyday financial transactions, whilst investment banks act as intermediaries in capital markets and assist in the strategic reshaping of our business landscape. Understanding these differences will enable us as banking professionals to better appreciate the interconnectedness of our financial system and contribute to its ongoing success. Want to learn more? Claire Trithel on LinkedIn. Introduction to Treasury: Understanding the Financial Landscape. The modern world's financial ecosystem is a complex interplay of institutions, individuals, and market mechanisms. At the heart of this system are banks, which facilitate the exchange of capital between those who have it and those who need it, acting as a critical engine for economic growth. To navigate this vast and ever-evolving financial universe, it's essential to understand the foundational concepts, such as treasury, lending and deposit taking, and the role of banks. The role of banks and maturity transformation. Banks, including other lending and deposit-taking institutions like building societies in the UK, play a crucial role in the global economy. They serve as conduits between depositors, typically retail, and corporate entities and borrowers, who may require a diverse range of loans, from short-term overdrafts to long-term property loans. The defining characteristic of these institutions is their ability to undertake maturity transformation. In other words, banks use short-term deposits, which can be withdrawn at short notice, to fund long-term loans. This is only possible due to the confidence depositors have in banks. Should all depositors decide to withdraw simultaneously, the bank would not be able to fulfill its obligations, leading to a run on the bank. The financial markets, connecting money holders and users. Apart from banks, the financial markets serve as a crucial conduit for linking those with money, such as insurance companies and pension funds, and those requiring investment businesses providing goods and services. These markets are categorized into short-term money markets and long-term capital markets. Businesses can bypass banks and raise funds directly from the market by issuing securities like commercial paper, short-term, or bonds and equities, long-term. This process is facilitated by investment banks or broker-dealers, who advise on the type of security to issue and help place it with investors. Post-issuance, they also provide liquidity to investors by making a market in the security, a function distinct from the maturity transformation performed by banks. The dynamic and complex financial system. The financial system is a dynamic and constantly evolving universe, including banks, other financial institutions, money and capital markets, individuals, corporates, governments, and regulatory bodies. It underwent a significant transformation following the financial crisis of 2007, as boundaries ruptured and chaos ensued. This led to long-term restructuring and rebalancing, manifesting as new regulations for banks and shifts in political, economic, and social norms worldwide. These changes have necessitated a fundamental review of bank business models and a rethinking of conventional labels and definitions. Tools like the Bank Profiles Matrix can help understand the essential features that define these banks amidst this change. Understanding Treasury for effective financial maneuvering. In conclusion, understanding the intricacies of the financial system and the role of key players like banks and financial markets is essential in grasping the concept of Treasury. As regulations and global economic landscapes continue to evolve, it is crucial to keep abreast of these shifts to navigate the financial universe effectively. The Treasury, acting as the custodian of an organization's financial operations, is a vital component in this intricate network. Want to dive deeper into the world of Treasury? Visit linkedin.com/in/Claire-Tritehall for in-depth resources and insights. Remember, the financial landscape is constantly evolving, and staying informed is the key to success. Want to learn more? Claire Tritehall on LinkedIn. Types of liquidity risks and how to manage them. Liquidity risk refers to the potential of not being able to meet financial obligations when they come due. It's a crucial aspect of risk management that businesses and individuals need to be aware of. In this video, we will discuss the different types of liquidity risks and some strategies to manage them effectively. 1. Funding liquidity risk. This occurs when a company or individual is unable to meet their short-term funding needs. It may be due to an unexpected decrease in cash flow, difficulty in accessing credit, or a sudden increase in financial obligations. To manage funding liquidity risk, it's important to maintain adequate cash reserves, diversify funding sources, and establish relationships with multiple lenders. 2. Market liquidity risk. Market liquidity risk refers to the inability to buy or sell assets at fair prices due to a lack of market participants or an unstable market condition. This risk can adversely impact asset valuations and prompt financial losses. To manage market liquidity risk, it's essential to regularly assess market conditions, maintain a diversified portfolio, and ensure access to alternative sources of liquidity. 3. Asset liquidation risk. Asset liquidation risk arises when an individual or organization wants to sell an asset, but cannot find a buyer at a reasonable price. This risk is common in less liquid investments, such as real estate or illiquid financial instruments. To manage asset liquidation risk, it's important to carefully evaluate the liquidity of assets before investing and have contingency plans in case liquidation is necessary. 4. Contagion liquidity risk. Contagion liquidity risk occurs when the liquidity problems of one institution spread to other interconnected institutions. This risk intensifies during financial crises or economic downturns when confidence in the market declines. To manage contagion liquidity risk, policymakers and regulators must implement measures to enhance financial stability, promote transparency, and ensure that institutions have sufficient capital buffers. 5. Behavioral liquidity risk. Behavioral liquidity risk is characterized by irrational market behavior, such as panic selling or irrational exuberance, which can lead to sudden liquidity shortages. To manage behavioral liquidity risk, it's important to maintain a long-term perspective, avoid impulsive investment decisions, and diversify across different asset classes. 6. Legal and regulatory liquidity risk. Legal and regulatory liquidity risk arises when changes in laws or regulations restrict access to liquidity or require the divestment of certain assets. To manage this risk, it's crucial to stay informed about changes in regulatory frameworks, maintain compliance, and develop alternative strategies to address regulatory requirements. Liquidity risks cannot be eliminated entirely, but they can be effectively managed through a combination of prudent financial planning, risk assessment, and proactive strategies. By understanding and addressing the various types of liquidity risks, individuals and organizations can minimize their vulnerability to financial instability. Want to learn more? Claire Tritehall on LinkedIn. Introduction to Treasury: the evolution of money. As the fundamentals of economies have evolved, so too has the concept of money and the banking system that underpins it. The evolution from barter to fiat money, the role of government in monetary policy, and the nature and impact of financial crises have all played a part in shaping today's banking landscape. Evolution from barter to fiat money. In the absence of money as a medium of exchange, barter becomes necessary for everyday survival. However, barter systems pose challenges, as they require identifying and matching parties with complementary needs and resources. Whatever is used as money needs to fulfill three critical functions: to act as a medium of exchange, a unit of account, and a store of value. It becomes even more readily acceptable if it holds intrinsic value, like gold or silver, which traditionally served as money due to their intrinsic value and acceptance for tax payment, establishing their credibility. However, as economies evolved, carrying gold and silver coins became impractical and expensive. In response, Central banks introduced notes that could be exchanged on demand for these precious metals. Eventually, this exchangeability was abandoned in favor of fiat money, legal tender established by government decree. With the advent of fiat money, its value became linked to the economic health of the jurisdiction, of its issuer, and the confidence in its future stability. The advent of banks and the rise of credit. During the transition from barter to fiat money, banks emerged. They started by accepting deposits, settling payments, and lending depositors money. However, banks evolved to lend money beyond their deposits, creating new money in the form of loans. This process created interbank settlements and imbalances, leading to the establishment of reserve accounts held by each bank at the central bank, subject to an interest cost set by the central bank, known as the bank rate. The role of government and central banks. Central banks can influence the amount of credit in an economy by setting the bank rate and managing reserve accounts. By manipulating the bank rate, central banks can influence borrowing levels and hence, the level of economic activity. In many economies, including the UK, monetary policy is used to manage future growth. Inflation and bank interest rate are two key metrics. The Bank of England's Monetary Policy Committee, consisting of economic experts, is responsible for setting the interest rate. During financial crises, unconventional measures such as quantitative easing, which injects more money directly into the economy, can be employed to stimulate investment. Financial crises and their impact. Financial crises, including banking crises, are often inevitable and can have a profound impact on asset prices, the economy, and government debt. Leading indicators of impending crises include real exchange rates, housing prices, and equity prices. The 2008 financial crisis, the most severe since the Great Depression, led to significant regulatory changes worldwide, particularly in the UK. These changes included transferring banking supervision back to the Bank of England, introducing a twin peak system for conduct and prudential regulation, and establishing a resolution and recovery framework for failing banks. Conclusion. In conclusion, understanding the evolution of money, the role of banks, and the impact of financial crises is fundamental for banking professionals navigating today's complex economic landscape. Want to learn more? Claire Trifle on LinkedIn. Introduction to Treasury, non-bank financial institutions. When it comes to managing money, there are two types of financial institutions: banks and non-bank financial institutions, NBFI. In this comprehensive guide, we will take a closer look at the key differences between these institutions and their roles in the financial system. Bank financial institutions. Banks are the most common type of financial institution that most people are familiar with. They are regulated by banking authorities and offer a wide range of financial services to individuals and businesses. Some of the services offered by banks include personal and business bank accounts, loans and mortgages, investment services, credit and debit cards, payment processing, risk management, treasury operations. Banks are also responsible for safeguarding customer deposits and providing liquidity to the financial system through their lending activities. They play a critical role in the economy as they facilitate the circulation of money and support economic growth. Non-bank financial institutions. Non-bank financial institutions, on the other hand, are financial entities that offer similar services as banks, but are not regulated as strictly. Examples of NBFI include insurance companies, mutual funds, pension funds, finance companies, hedge funds. While these institutions may not be regulated as heavily as banks, they still provide essential financial services to individuals and corporations. However, they often focus on specific areas of the financial market, such as insurance or investment management. Key differences. There are several key differences between banks and non-bank financial institutions. Regulation. Banks are heavily regulated by banking authorities, such as central banks, and financial regulatory bodies. This strict regulation ensures the stability and integrity of the banking system. On the other hand, non-bank financial institutions have different regulatory frameworks depending on their specific activities. Deposit insurance. Banks usually offer deposit insurance, which guarantees that customers' deposits up to a certain limit are protected from bank failures. This provides an additional layer of security for depositors. Non-bank financial institutions generally do not offer deposit insurance, which means that customers may bear more risk. Lending opportunities. Banks have direct access to lending opportunities, as they can create money through the fractional reserve banking system. This allows them to provide loans and mortgages to individuals and businesses. Non-bank financial institutions rely on other sources of funding, such as capital markets or investor funds, to provide lending opportunities. Monetary policy transmission. Banks play a crucial role in the transmission of monetary policy. Central banks use various tools to influence interest rates and money supply, and banks are the primary channels through which these policies are implemented. Non-bank financial institutions are not directly involved in the transmission of monetary policy. Conclusion. In summary, banks and non-bank financial institutions are two different types of financial entities that provide essential services to individuals and businesses. While banks are heavily regulated and offer a wide range of services, non-bank financial institutions often specialize in specific areas of the financial market. Understanding the differences between these institutions is important for individuals and businesses to make informed decisions about their financial needs. Want to learn more? Claire Trithel on LinkedIn.
Since joining the Global Banking Hub, my career has completely transformed. I was recently promoted, and a big part of that success is thanks to the knowledge and insights I've gained from the Hub. Suddenly, I became the go-to person in the office for up-to-date banking news and how global events would impact our strategic decisions. I'm constantly complimented on my ability to anticipate market changes and offer solutions that align with our bank's goals. The weekly reports and in-depth courses have sharpened my strategic thinking and given me the confidence to contribute at a higher level. People started noticing the change almost immediately. My boss, my team, everyone. The Global Banking Hub has genuinely given me the tools to elevate my career. Join as a member of the Global Banking Hub today and gain the knowledge, insights, and confidence to stand out and lead in your organization. Your promotion could be just a step away.
What is repricing gap, and how does it impact banking book hedging? Repricing gap is a concept commonly used in risk management for banks. It refers to the difference between the maturity of a bank's assets and liabilities. In other words, it measures how quickly the interest rates on a bank's assets and liabilities can change. Understanding repricing gap. Banks engage in various activities that expose them to interest rate risk. They borrow money from depositors and other sources, and they lend it out to borrowers. These activities create a gap between the rates they receive on loans and investments, and the rates they pay on deposits and other liabilities. The gap can be positive or negative. A positive gap means that the bank's liabilities will reprice, adjust, faster than its assets in response to changes in interest rates. Conversely, a negative gap means that the bank's assets will reprice faster than its liabilities. Impact on banking book hedging. Repricing gap is a crucial consideration when it comes to hedging the banking book. Hedging involves using financial instruments to reduce or eliminate potential losses due to interest rate changes. The goal is to create an effective hedge that will offset the impact of interest rate fluctuations on the bank's net income and economic value. Banks with a positive repricing gap often seek to reduce their exposure to rising interest rates. They can do this by using interest rate swaps or other derivatives to convert their fixed-rate assets or liabilities into floating rate, or vice versa. By doing so, they can protect their profitability in case interest rates go up. On the other hand, banks with a negative repricing gap may choose to hedge against falling interest rates. They can use derivatives to convert their floating-rate assets or liabilities into fixed-rate, or vice versa. This helps them mitigate the risk of declining revenues in a low-rate environment. Challenges and considerations. Repricing gap hedging is not without challenges. One of the primary difficulties faced by banks is accurately forecasting interest rate movements. Economic conditions, market factors, and unpredictable events can all impact interest rates, making accurate predictions challenging. Another consideration is the cost of hedging. Banks need to assess the cost-effectiveness of the hedging strategy they employ. They must carefully balance the potential benefits of hedging against the costs involved in implementing and maintaining the hedge. Conclusion: repricing gap plays a significant role in banking book hedging strategies. Understanding the gap and its impact on a bank's assets and liabilities helps institutions manage interest rate risk effectively. By utilizing appropriate hedging techniques, banks can protect their profitability and navigate the changing interest rate environment. Want to learn more? Claire Trifle on LinkedIn. The importance of liquidity management for banks. Liquidity management is a crucial aspect of running a bank. It refers to the ability to quickly and efficiently meet the financial obligations of the bank while maintaining a safe and sound financial position. In this video, let's explore the importance of liquidity management for banks. 1. Ensuring stability and solvency. Effective liquidity management ensures the stability and solvency of a bank. By maintaining an optimal level of liquidity, banks can meet their short-term obligations, such as customer withdrawals or unforeseen expenses, without facing insolvency or financial distress. 2. Managing risks. Liquidity risk is a major concern for banks. It refers to the risk of not having enough liquidity to meet their obligations when they come due. By proactively managing liquidity, banks can mitigate this risk and avoid potential funding shortfalls or reliance on costly emergency liquidity sources. 3. Regulatory compliance. Liquidity management is a regulatory requirement for banks. Regulatory authorities impose liquidity standards and ratios that banks must comply with to ensure the safety and stability of the overall financial system. Banks that fail to meet these requirements may face penalties, reputational damage, or even regulatory intervention. 4. Funding operational activities and growth. Adequate liquidity is essential for funding day-to-day operational activities, such as lending, investing, and paying operational expenses. Without proper liquidity management, a bank may struggle to meet the financing needs of its customers and hinder its own growth prospects. 5. Maintaining market confidence. One of the critical elements of liquidity management is maintaining market confidence. A bank with a strong liquidity position not only reassures its customers, but also instills confidence in depositors, lenders, and investors. This confidence can strengthen the bank's reputation, attract more deposits, and support its overall financial health. 6. Adapting to market changes. Effective liquidity management enables banks to adapt to market changes and unforeseen events. By having sufficient liquidity buffers, banks can navigate through market disruptions, economic downturns, or credit market freezes. It provides them with the flexibility to respond to changing customer needs and avoid liquidity-based crises. 7. Enhancing profitability. Optimal liquidity management can enhance a bank's profitability. By carefully balancing liquidity needs and costs, banks can minimize the impact of liquidity hoarding or excessive reliance on expensive funding sources. This can free up capital for profitable lending and investment activities, ultimately boosting the bank's bottom line. In conclusion, liquidity management plays a vital role in the overall financial stability, risk management, and profitability of banks. By effectively managing liquidity, banks can ensure stability, meet regulatory requirements, and confidently navigate through changing market conditions. Want to learn more? Claire Trifle on LinkedIn. The basics of hedging in bank treasury management. Welcome to this video on the basics of hedging in bank treasury management. Hedging is an essential tool for banks to mitigate various types of risks. In this video, we will discuss the key concepts and strategies involved in hedging. What is hedging? Hedging is a risk management strategy used by banks to protect themselves against unfavorable market movements. It involves taking offsetting positions in financial instruments to minimize potential losses. Types of risks. Banks face numerous risks, including interest rate risk, foreign exchange risk, credit risk, and liquidity risk. Hedging helps banks manage these risks effectively. Interest rate hedging. Interest rate hedging is commonly used by banks to protect against fluctuations in interest rates. Banks can use derivatives, such as interest rate swaps or futures contracts, to hedge their interest rate exposure. Foreign exchange hedging. Foreign exchange hedging is crucial for banks that engage in international transactions. By using financial instruments like forward contracts or options, banks can hedge their exposure to foreign currency fluctuations. Credit risk hedging. Banks rely on collateral and credit derivatives to manage credit risk. Collateral helps secure loans, while credit derivatives like credit default swaps provide insurance against potential defaults. Liquidity risk hedging. Liquidity risk refers to the possibility of a bank facing difficulty in meeting its short-term obligations. Banks can hedge liquidity risk by maintaining a diversified portfolio of liquid assets and utilizing funding instruments, such as credit lines. Hedging strategies. Banks employ various hedging strategies to manage risks effectively. 1. Natural hedging. Natural hedging involves matching assets and liabilities with similar characteristics to reduce exposure to risks. For example, matching fixed-rate loans with fixed-rate deposits reduces interest rate risk. 2. Derivatives hedging. Derivatives instruments like futures, options, and swaps are widely used for hedging purposes. Banks can customize derivatives to align with their specific risk profiles. 3. Cross-hedging. Cross-hedging involves hedging risks with instruments that are not an exact match. For example, using an interest rate swap to hedge against a change in the yield curve. 4. Dynamic hedging. Dynamic hedging is an ongoing process where banks continuously adjust their hedges to reflect changes in market conditions. This strategy requires active monitoring and timely adjustments. Benefits of hedging. Effective hedging offers several benefits to banks, including reducing exposure to market risks, enhancing financial stability, protecting against potential losses, increasing confidence among stakeholders, promoting efficient capital allocation. Conclusion. Hedging is an essential tool in bank treasury management. By understanding the types of risks and implementing appropriate hedging strategies, banks can effectively manage their exposure to adverse market conditions. Remember, successful hedging requires careful evaluation, monitoring, and adjustment based on changing market dynamics. Thank you for watching. Want to learn more? Claire Trifle on LinkedIn. Understanding liquidity management in banking. Welcome to this informative video on liquidity management in banking. Liquidity management is a critical function of any bank to ensure its stability, growth, and ability to meet its obligations. In this video, we will explore what liquidity management is, why it is important, and the strategies banks use to manage liquidity effectively. What is liquidity management? Liquidity management refers to the process of monitoring, controlling, and optimizing the availability of liquid assets in a bank. Liquid assets are those that can be easily converted into cash without significant loss. Banks need to maintain sufficient liquidity to meet depositor withdrawals, cover loan disbursements, and handle any unexpected cash outflows. Importance of liquidity management. Effective liquidity management is crucial for several reasons. Meet customer demands. Banks need to have enough liquid assets to fulfill customer withdrawal requests promptly. Failure to do so can lead to reputational damage and loss of customer trust. Cash flow stability. By managing liquidity well, banks can ensure a steady inflow of deposits to cover loan disbursements and operational expenses. This contributes to overall financial stability. Compliance and regulations. Regulatory bodies require banks to maintain adequate liquidity levels to protect depositors' interests and minimize systemic risks in the financial system. Liquidity management strategies. Banks employ various strategies and tools to manage liquidity effectively. Here are some common ones. Cash reserves. Banks hold a certain portion of their assets in cash and highly liquid securities, such as government bonds. These reserves act as a safety net to meet unexpected liquidity needs. Asset-liability management. Banks analyze their assets and liabilities to align their maturity profiles. Contingency planning. Banks develop contingency plans to prepare for potential liquidity shocks or crises. Central bank facilities. Banks can access liquidity from central banks through various facilities, such as standing lending facilities or discount windows. Stress testing. Banks conduct regular stress tests to assess their ability to withstand adverse liquidity scenarios. Conclusion. In conclusion, liquidity management is a vital aspect of banking operations. By effectively managing liquidity, banks can meet customer demands, ensure cash flow stability, and comply with regulatory requirements. Employing strategies like cash reserves, asset liability management, contingency planning, and utilizing central bank facilities can help banks mitigate liquidity risks and maintain financial stability. Thank you for watching this video on understanding liquidity management in banking. Want to learn more? Claire Trithel on LinkedIn. Liquidity stress testing, idiosyncratic, market-wide, and combined scenarios. Liquidity stress testing is an important tool for financial institutions to assess their ability to withstand adverse market conditions. It helps identify and manage potential liquidity risks. In this video, we will discuss 3 types of liquidity stress testing scenarios: idiosyncratic, market-wide, and combined. 1. Idiosyncratic scenarios. Idiosyncratic scenarios are tailored to specific risks that could impact an individual institution. These scenarios test the firm's resilience to events specific to its business model or operational structure. For example, a bank heavily reliant on short-term funding may simulate a scenario where its main funding source dries up. By stress testing this idiosyncratic risk, the institution can assess its vulnerability and take appropriate actions to mitigate it. 2. Market-wide scenarios. Market-wide scenarios focus on testing the impact of adverse market conditions on the entire financial system. These scenarios simulate events such as economic downturns, changes in interest rates, or liquidity freezes. By considering the interconnectedness of different financial institutions and markets, market-wide stress tests help evaluate the systemic risks that can arise during a crisis. 3. Combined scenarios. Combined scenarios involve the integration of idiosyncratic and market-wide stress testing. This comprehensive approach provides a more realistic assessment of a financial institution's resilience. By considering both individual risks and general economic conditions, combined scenarios enable a more accurate understanding of the institution's ability to withstand a range of stress events. Why conduct liquidity stress testing? Liquidity stress testing is a critical risk management practice for financial institutions. By conducting these tests regularly, institutions can identify potential vulnerabilities and weaknesses in their liquidity risk management processes, improve risk governance and decision-making capabilities, enhance overall resilience and preparedness for adverse market conditions, meet regulatory requirements and demonstrate compliance. Conclusion. Liquidity stress testing is a fundamental practice in the risk management arsenal of financial institutions. It helps organizations assess their ability to withstand adverse market conditions and identify potential vulnerabilities. By conducting idiosyncratic, market-wide, and combined scenarios, institutions can gain a comprehensive understanding of their liquidity risk profile. Implementing effective liquidity stress testing practices is essential for maintaining financial stability and safeguarding the interests of stakeholders. Want to learn more? Claire Trithel on LinkedIn. Managing bank liquidity, BAU versus stress scenario planning. Bank liquidity management is a crucial aspect of the banking industry. Ensuring that a bank has enough liquidity to meet its obligations is essential for stability and financial health. In this video, we will discuss 2 key approaches to managing bank liquidity: business as usual, BAU, and stress scenario planning. Business as usual, BAU. BAU liquidity management involves the day-to-day management of a bank's liquidity needs. Banks employ various tools and strategies to maintain sufficient liquidity levels. These include liquidity monitoring. Banks continuously monitor their liquidity positions through various metrics and ratios to ensure they have enough cash and liquid assets to meet their short-term obligations. Liquidity buffers. Banks maintain liquidity buffers, such as cash reserves and highly liquid assets, to handle unexpected events, regulatory requirements, and fluctuations in customer deposit levels. Funding diversification. Banks employ diversification strategies to secure funding from various sources, reducing their dependence on a single funding channel. Cash flow projections. Banks use cash flow projections to analyze and forecast their future liquidity needs. Contingency funding plan. Banks develop contingency funding plans, CFPs, to outline actions and strategies to follow during periods of stress or market disruptions. While BAU liquidity management focuses on maintaining day-to-day liquidity needs, banks also employ stress scenario planning to prepare for severe market events. Stress scenario planning. Stress scenario planning involves simulating extreme, yet plausible, scenarios to assess a bank's ability to withstand adverse conditions. This proactive approach helps banks identify vulnerabilities, quantify potential liquidity shortfalls, and develop contingency measures. Here are the key steps involved. Scenario development. Banks create stress scenarios by identifying potential events that could significantly impact liquidity. Liquidity stress testing. Banks conduct comprehensive liquidity stress tests to simulate these scenarios and assess the impact on their liquidity positions. Contingency planning. Based on the results of stress tests, banks develop detailed contingency plans to address potential liquidity shortfalls. Regulatory compliance. Stress scenario planning is also an important regulatory requirement. By integrating stress scenario planning into their liquidity management strategies, banks can enhance resilience and readiness to handle adverse market conditions. In conclusion, managing bank liquidity requires a combination of business as usual (BAU) practices and stress scenario planning. By implementing robust liquidity management strategies in normal times and preparing for severe scenarios, banks can ensure their financial stability and ability to meet their obligations even in challenging circumstances. Want to learn more? Claire Trifle on LinkedIn.
Join the Global Banking Hub today and unlock an extensive library of Treasury video courses with new content added every month to keep you up to date on the latest industry standards and practices. Whether you're looking to deepen your understanding of interest rate risk management, liquidity coverage ratios, or Basel III compliance, our expert courses are designed to give you the skills and knowledge you need to excel. Each course comes with a practical certification opportunity, allowing you to demonstrate your expertise and advance your career with feedback from a senior Treasury professional. As a member, you'll also receive our weekly Global Banking Update reports, packed with actionable insights on global banking trends, regulatory changes, and market movements, giving you the tools to apply the latest developments to your organization's strategic decisions. Finally, our in-depth how-to guides provide step-by-step solutions to complex Treasury challenges, from calculating liquidity ratios to managing non-maturity deposits. These practical guides ensure you're equipped to tackle the real-world issues that matter most to your role. Become a member today.
Managing complex relationships. Treasury's interaction with other business units. In any organization, the Treasury Department plays a crucial role in managing financial assets and liabilities. However, its responsibilities extend beyond numbers and spreadsheets. Treasury is often tasked with developing and maintaining strong relationships with other business units within the company. In this video, we'll explore some key aspects of Treasury's interaction with other departments. Understanding the needs. To effectively manage complex relationships, Treasury needs to have a deep understanding of the needs and goals of other business units. This involves building strong communication channels and actively listening to the concerns and objectives of each department. By comprehending the different demands, Treasury can align its strategies with the overall goals of the organization. Collaborative decision-making. Treasury's interaction with other business units often involves making collaborative decisions. Whether it's securing funding for a new project or managing cash flow during challenging times, Treasury needs to work closely with other departments to find solutions that benefit the entire organization. This requires open-mindedness, compromise, and a willingness to explore different approaches to achieve mutually beneficial outcomes. Risk management. Treasury has a crucial role in managing financial risks. By collaborating with other departments, such as procurement, sales, and operations, Treasury can gain valuable insights into the potential risks across the organization. This helps in developing comprehensive risk management strategies that protect the business from financial vulnerabilities. By actively engaging with other departments, Treasury can identify and mitigate risks early, ensuring the long-term stability and success of the organization. Communication and transparency. Effective communication and transparency are essential in managing complex relationships. Treasury must ensure that the flow of information is clear, timely, and accurate. Regular meetings, reports, and presentations are important tools for keeping other business units informed about financial matters. By sharing relevant information, Treasury can foster trust and collaboration, enabling smoother operations and decision-making processes. Educating other business units. Treasury may often find itself educating other business units on complex financial matters. Whether it's explaining the impacts of interest rate fluctuations or the importance of cash flow management, Treasury must be skilled in simplifying complex concepts to ensure that other departments understand the financial implications of their decisions. By providing educational resources and offering training sessions, Treasury can empower other departments to make informed financial choices, ultimately benefiting the organization as a whole. Building relationships. Relationship building is at the core of Treasury's interaction with other business units. By establishing strong connections with key stakeholders, Treasury can foster collaboration, gain support for initiatives, and navigate challenges more effectively. Building relationships involves proactive engagement, active listening, and demonstrating value and expertise in financial matters. It's about being a trusted partner to other departments, continuously adding value, and being responsive to their needs. Managing complex relationships between Treasury and other business units is essential for the overall success of an organization. By understanding the needs of other departments, collaborating on decision-making, managing risks, communicating transparently, educating other business units, and building relationships, Treasury can effectively contribute to the achievement of the company's goals. Want to learn more? Claire Trifle on LinkedIn. Currency risk. Prudent practices for effective management. Currency risk, also known as foreign exchange risk, is the potential for financial loss due to fluctuations in exchange rates. In today's global economy, businesses need to be aware of this risk and implement effective management practices. In this video, we will discuss some prudent practices to manage currency risk. 1. Understand and identify exposure. The first step in managing currency risk is understanding and identifying your exposure. Determine which currencies your business operates in and assess the potential impact of exchange rate fluctuations on your cash flows, revenues, and expenses. This will help you prioritize which currencies to focus on and devise appropriate risk management strategies. 2. Hedge currency risk. Hedging is a commonly used practice to mitigate currency risk. It involves taking positions in the foreign exchange market that offset the potential losses from adverse exchange rate movements. There are various hedging instruments available, such as forward contracts, futures, options, and currency swaps. Consult with a financial advisor or risk management specialist to determine the most suitable hedging strategy for your business. 3. Diversify revenue streams. An effective way to reduce currency risk is diversifying your revenue streams. By expanding into new markets and offering products or services in different currencies, you can potentially offset losses in one currency with gains in another. This strategy can help minimize the impact of exchange rate fluctuations on your overall business performance. 4. Monitor and stay informed. Stay abreast of the latest economic and political developments that can impact currency exchange rates. Factors such as interest rate changes, geopolitical events, and government policies can heavily influence exchange rates. Regularly monitor these factors and assess their potential impact on your business. This will enable you to make informed decisions and adjust your risk management strategies accordingly. 5. Establish a currency risk management policy. Develop a comprehensive currency risk management policy that clearly outlines your risk tolerance, hedging strategies, and risk monitoring procedures. Ensure all key stakeholders in your organization understand and adhere to this policy. Regularly review and update the policy to reflect evolving market conditions and changes in your business operations. 6. Work with knowledgeable partners. Collaborate with knowledgeable partners, such as banks, financial institutions, or currency risk management providers. They can offer expertise, tools, and solutions to help you effectively manage currency risk. Seek their guidance in understanding the complexities of currency markets and in implementing appropriate risk management strategies. In conclusion, currency risk is a significant consideration for businesses operating in the global marketplace. By understanding your exposure, hedging currency risk, diversifying revenue streams, monitoring market conditions, establishing a risk management policy, and working with knowledgeable partners, you can minimize the impact of currency fluctuations and protect your business from potential financial losses. Want to learn more? Claire Trifle on LinkedIn. Defining high-quality liquid assets, HQLA. In the world of finance, high-quality liquid assets, HQLA, play a crucial role in ensuring the stability and liquidity of financial institutions. But what exactly are HQLA, and why are they so important? Let's delve deeper into the definition and significance of HQLA. Understanding HQLA. HQLA refers to assets that can be easily converted into cash without significant loss of value, even in times of financial stress. These assets are considered to have a low credit risk and are easily tradable in liquid markets. They serve as a safety net, providing financial institutions with the necessary resources to meet their funding obligations promptly. Criteria for HQLA designation. To be classified as an HQLA, an asset must meet certain criteria defined by regulatory bodies. The key requirements include high credit quality. The asset must have a low risk of default, typically backed by sovereign entities or highly rated institutions. Low volatility. HQLA must display stability in their market value, meaning they are less susceptible to large price fluctuations. Ease of convertibility. They should be readily convertible into cash, allowing institutions to access funds quickly if needed. Types of HQLA. HQLA can take various forms, including cash, physical currency, and central bank reserves are the most liquid of all assets. They are readily available to be used as needed. Government securities. These include bonds issued by the government, such as Treasury bills and bonds. They are considered safe and highly liquid. Highly rated corporate bonds. Bonds issued by reputable and financially stable corporations with excellent credit ratings can also be classified as HQLA. Cash equivalent securities. These securities have a short-term maturity, such as certificates of deposit, CDS, and commercial paper. They offer both liquidity and low risk. Importance of HQLA. HQLA plays a critical role in maintaining the stability of financial institutions and the broader financial system. Here's why they are important. Liquidity management. HQLA provides a buffer of easily accessible assets that institutions can utilize in times of financial strain or unexpected liquidity needs. Regulatory compliance. Many regulatory bodies mandate financial institutions to maintain a certain level of HQLA as a safeguard against potential funding shortfalls. Conclusion. High-quality liquid assets, HQLA, are a cornerstone of financial stability. Their easy convertibility to cash, low credit risk, and stability in value make them vital for liquidity management and regulatory compliance. By holding an ample supply of HQLA, financial institutions can ensure their ability to meet their funding obligations promptly, even in times of market stress. Want to learn more? Claire Trifle on LinkedIn. Understanding the symbiosis. Strong and simple framework versus Basel. The banking industry is a complex landscape, requiring a deep understanding of multifaceted regulations and frameworks. It's not just about grasping the regulations themselves, but also comprehending how they interact with one another to form a cohesive regulatory environment. Two key components in the UK banking sector are the strong and simple framework and the Basel regulations, particularly Basel 3.1. Let's explore the symbiotic relationship between these two regulatory elements and what it means for the future of the UK's banking industry. Basel regulations, the regulatory underpinning. The Basel regulations are internationally recognized banking regulations established by the Basel Committee on Banking Supervision. Their goal is to ensure sound and conservative financial practices by setting minimum standards for capital adequacy, stress testing, and market liquidity risk. Banks are required to maintain a certain level of capital to safeguard the financial system against economic downturns. Basel 3.1, the most recent adaptation, aims to refine and strengthen the measures introduced in Basel III. Strong and simple framework, a UK perspective. In contrast to the broad-reaching and global scope of Basel regulations, the strong and simple framework is a regulatory regime designed by the Prudential Regulation Authority, PRA, specifically for smaller banks and building societies in the UK. Its purpose is to simplify and optimise the regulatory requirements for non-systemically important institutions, fostering competition, innovation, stability, and safety. The intricate balance, Basel and strong and simple. The interplay between Basel and the strong and simple framework is where the real intrigue lies. While both frameworks strive for the same objective of a safe and sound financial system, their approaches differ significantly. Basel regulations are intended for universal application, covering both large and small financial institutions. On the other hand, the strong and simple regime introduces proportionality, tailored specifically to the needs of smaller institutions. The PRA estimates that approximately 30 banks and 33 building societies would be eligible for the strong and simple regime. Implementation timelines, a race against time. The UK has set an implementation date for Basel 3.1 of the 1st of July 2025, having delayed the initial implementation date by 6 months. In contrast, the strong and simple regime plans to implement its initial phase in the second half of 2024. This staggered timeline presents smaller financial institutions with a crucial decision. They can initially comply with Basel 3.1 and later transition to the strong and simple regime, or they could adopt a transitional capital regime, TCR, and directly embrace the strong and simple framework once it is finalized. This decision has practical implications in terms of capital requirements and operational disruptions. Capital requirements and liquidity ratios, a delicate balance. Understanding the capital implications is paramount. Basel 3.1 mandates banks to maintain specific levels of capital adequacy and liquidity ratios, such as the Net Stable Funding Ratio, NSFR. The strong and simple regime proposes a new metric called the Retail Deposit Ratio, RDR, specifically designed to gauge the stability of retail funding. Want to learn more? Claire Trithel on LinkedIn. Conservative versus aggressive, the balance in Treasury risk management. When it comes to managing Treasury risk, there are two main approaches, conservative and aggressive. Both strategies have their pros and cons, and finding the right balance is crucial for a well-managed Treasury. Let's explore the key differences and considerations between conservative and aggressive Treasury risk management. The conservative approach. The conservative Treasury risk management strategy focuses on preserving capital and minimizing risk. The primary objective is to prioritize the safety of funds. Under this approach, companies typically opt for low-risk investments, such as government bonds or highly rated securities. The conservative strategy can provide stability and predictable returns over time. However, there are drawbacks to being too conservative. The conservative approach may limit the potential for higher returns, as the focus is on capital preservation rather than maximizing profits. Additionally, in a low-interest rate environment, conservative investments may not generate significant income, which can affect overall financial performance. The aggressive approach. In contrast, The aggressive Treasury risk management strategy aims to generate higher returns by taking on more risk. With this approach, companies may invest in a range of higher-yielding securities or explore more speculative investments, such as stocks or derivatives. The goal is to optimize returns and actively seek opportunities to increase profits. While an aggressive approach can potentially yield greater rewards, it also comes with increased risks. Higher volatility and market uncertainties can put the capital at a greater risk of loss. It requires a deep understanding of market dynamics and active management to navigate successfully. Finding the balance. Finding the right balance is fundamental in Treasury risk management. The suitability of each approach depends on various factors, such as the organization's risk appetite, financial goals, and market conditions. Here are some key considerations when striking the balance. Risk appetite. Assess the company's tolerance for risk. Investment horizon. Consider the time frame for investment goals. Longer investment horizons may allow for a more aggressive stance, as there is more time to recover from potential losses. Diversification. Mitigate risk by diversifying holdings. A well-diversified portfolio can help reduce exposure to individual asset volatility. Market conditions. Stay informed about market trends, interest rates, and economic indicators. This knowledge will shape the approach and help make informed investment decisions. Conclusion. Treasury risk management is about striking the right balance between conservative and aggressive strategies. While the conservative approach focuses on capital preservation, the aggressive approach pursues higher returns. Understanding risk appetite, investment horizon, diversification, and market conditions are key factors in finding the optimal strategy. Ultimately, the goal is to achieve the right balance that aligns with the organization's objectives while effectively managing Treasury risk. Want to learn more? Claire Trifle on LinkedIn. Developing fiscal buffers, its importance and relevance to the banking sector. Financial institutions operate in a complex and ever-changing economic landscape. In light of the ongoing geo-economic fragmentation, rising inflation, and fluctuating commodity prices, prudent financial management is not just beneficial, it is essential. Building fiscal buffers is a conservative and advantageous approach that banks can adopt to navigate through economic uncertainties. The context. Global economic conditions have undergone significant changes, including geopolitical tensions, inflationary pressures, and a fast-paced monetary policy tightening. Risk management has become more important than ever, making the need for fiscal buffers crucial. These buffers act as a safety net, providing banks with the necessary financial maneuverability during challenging times. Fiscal buffers explained. A fiscal buffer refers to the reserves or set-asides that a bank accumulates to safeguard against unforeseen events or financial downturns. These buffers may include cash reserves, highly liquid assets, and contingency funds. The aim is to build a cushion that can absorb shocks, allowing banks to navigate through economic difficulties without severely compromising their operations. Importance in the current scenario. Managing capital flows. Given the volatile geopolitical landscape, fiscal buffers are essential to manage unexpected shifts in capital inflows and outflows. Credit risk mitigation. With the tightening of monetary policy and increasing interest rates, there is an escalating risk of credit defaults. Fiscal buffers can act as a safety net in such situations. Compliance and regulation. Fiscal buffers can also help banks to meet regulatory requirements, including the guidelines set forth in Basel III, thereby averting potential sanctions and penalties. Realistic approaches to building buffers. Building a strong fiscal buffer requires a conservative approach based on accurate assessments of a bank's risk profile, operational costs, and market conditions. Here are some realistic approaches to building a strong fiscal buffer. Asset allocation. Diversifying assets into low-risk, highly liquid investments can bolster the buffer. Stress testing. Regular financial stress tests can offer valuable insights into how robust the existing buffer is against a variety of adverse scenarios. Revenue augmentation. Besides cost-cutting, banks should look for opportunities to increase revenue streams to add to the buffer fund. Policy reviews. Financial policies must be periodically reviewed and updated to reflect changes in economic conditions and regulatory landscapes. Want to learn more? Claire Trifle on LinkedIn. Navigating inflationary pressures, a banking sector perspective. Understanding inflationary pressures is crucial for the banking sector. Inflation poses challenges, but also opportunities for financial institutions to adapt and remain profitable. In this rapidly changing economic climate, this article provides a comprehensive guide to navigating inflation in the banking sector. The nature of inflation, a brief overview. Inflation is the rate at which prices for goods and services rise, eroding purchasing power. It affects not only consumers, but also banks as custodians of money and credit. Elevated inflation rates may necessitate a more restrictive monetary policy, affecting interest rates and lending conditions. Impacts on the banking sector. Asset value and loans. In an inflationary environment, banks must be prudent about the real value of their assets. The value of fixed income assets, such as bonds, tends to diminish. Loans at fixed interest rates may become less profitable, impacting the overall financial health of the institution. Deposits and interest rates. Deposits play a vital role in the banking business model. Rising inflation diminishes the real value of deposits. Higher inflation often leads to increased interest rates, affecting the cost of borrowing for banks and impacting their lending activities. Regulatory capital requirements. Banks are subject to capital requirements based on risk-weighted assets. Changes in inflation can affect these calculations, influencing the minimum capital banks need to hold. Remaining proactive in adjusting portfolios can help banks accommodate these changes. Strategies for navigating inflation. Risk assessment and management. Accurate risk assessment is essential. Realistic models and forecasts enable banks to prepare for potential increases in default rates and lower demand for loans in a higher interest rate environment. Hedging against inflation. Banks can use financial derivatives like inflation swaps or Treasury inflation-protected securities, TIPS, to hedge against inflation and safeguard their asset values. Repricing strategies. Adjusting pricing strategies for loans and deposits can help manage the impact of inflation. Introducing or modifying floating rate loans can protect banks from the erosion of real value. Effective communication. Clear and accurate communication with regulators and customers is crucial. Transparency regarding changes in loan and deposit terms helps maintain trust and confidence. Want to learn more? Claire Trifle on LinkedIn. The conservative strategy, achieving long-term stability in bank treasury. Bank treasury management is crucial for maintaining a bank's financial health, serving as the backbone of the financial ecosystem. To ensure long-term stability in this dynamic landscape, financial institutions must adopt a prudent approach. A conservative strategy is key to aligning financial objectives with effective risk management practices. The imperative for stability. In the ever-changing financial markets and regulatory landscape, stability is imperative. A conservative strategy helps financial institutions prepare for various economic scenarios and create a robust risk management framework. By setting realistic objectives and accurate assumptions, banks can make informed decisions that reflect their risk tolerance. Regulatory compliance, the prudent path forward. Regulatory compliance is non-negotiable for stability. Financial institutions must stay up to date with regulatory changes and ensure that all treasury activities comply with legal requirements. The adoption of a conservative strategy guarantees prudence in treasury operations, minimizing the risk of regulatory penalties. Liquidity management, the conservative advantage. Managing liquidity is crucial for a bank's operations. A conservative strategy focuses on maintaining sufficient liquidity to meet short-term obligations, preventing financial strain. By keeping a higher ratio of liquid assets to short-term liabilities, banks create a buffer against unexpected cash flow fluctuations. Hedging and derivatives, employing caution. Financial derivatives can be powerful risk management tools, but they require caution. A conservative strategy emphasizes limiting market risks, such as interest rate changes and currency fluctuations, rather than seeking speculative gains. By using derivatives for hedging purposes only, banks prioritize long-term stability and prudent risk management. Investment portfolio, balancing for optimal results. Creating a balanced investment portfolio is crucial for long-term stability. Financial institutions need to carefully consider the mix of investments to optimize returns while managing risks. A conservative strategy ensures a balanced approach that aligns with a bank's risk tolerance and financial objectives. Want to learn more? Claire Trifle on LinkedIn. Important market indicators. How Treasury professionals can be prepared. As a Treasury professional, staying on top of market indicators is crucial for making informed decisions and effectively managing financial risks. In this video, we will discuss several important market indicators and how you can stay prepared. 1. Interest rates. Interest rates have a significant impact on Treasury operations. Keep an eye on central bank decisions and changes in benchmark rates like LIBOR. By tracking interest rate trends, you can better anticipate borrowing costs and adjust your investment strategies accordingly. 2. Currency exchange rates. For companies with international operations, fluctuations in currency exchange rates can have a profound impact on financial results. Stay informed about exchange rate movements, especially for the currencies your organization deals with regularly. Consider hedging strategies to mitigate potential risks. 3. Credit spreads. Credit spreads reflect the difference in yield between corporate bonds and risk-free government bonds. Widening credit spreads indicate increased investor concerns about creditworthiness. Monitor credit spreads to anticipate potential changes in borrowing costs and assess counterparty credit risks. 4. Market volatility. Market volatility is a natural part of financial markets. Keep an eye on volatility indices like the VIX, CBOE Volatility Index, to gauge market sentiment and potential risks. Volatile markets can impact investment portfolio valuations and liquidity, so it's crucial to have contingency plans in place. 5. Economic indicators. Various economic indicators serve as barometers for overall economic health. Track indicators such as GDP growth, inflation, unemployment rates, and consumer spending to assess the macroeconomic environment. This information helps Treasury professionals make strategic decisions in line with economic trends. 6. Commodity prices. Commodity prices, such as oil, gas, and metals, influence business costs in various sectors. Treasury professionals should monitor commodity price movements, as they can impact both input costs and revenue streams. Understanding commodity market dynamics will aid in managing cash flow and budgets. 7. Regulatory changes. Keeping up with regulatory changes is vital for Treasury professionals. Stay informed about updates in financial regulations, tax rules, and compliance requirements. These changes can have a direct impact on liquidity management, cash repatriation, and Treasury operations. 8. Geopolitical events. Geopolitical events like elections, trade disputes, or geopolitical tensions can create market uncertainty and affect Treasury operations. Stay informed about global news and developments that may impact the markets. Preparing and adjusting strategies based on geopolitical risks will help mitigate potential disruptions. By tracking these important market indicators, Treasury professionals can make more informed decisions, effectively manage financial risks, and adapt their strategies to the ever-changing economic environment. Remember, it's crucial to maintain a holistic view of market indicators and conduct thorough research to ensure accurate analysis and decision-making. Want to learn more? Claire Trifle on LinkedIn. Understanding core risks in banking. Asset-liability management. In the world of banking, asset-liability management, ALM, is a critical function that addresses three primary risks faced by banks: capital risk, liquidity risk, and interest rate risk. For banking professionals, understanding these risks and implementing effective measures to manage them is crucial. Capital risk. Capital risk is essential in protecting banks from insolvency caused by losses. Traditionally, impaired loans were the main source of loss, but today, banks face diverse sources such as trading losses, goodwill impairment, and regulatory fines. Safeguarding a bank from insolvency ensures the protection of depositors' funds, a key responsibility. To finance future growth, core capital is primarily provided by equity investors and retained earnings after paying dividends. This capital, referred to as Core Tier 1 capital, must adhere to regulatory requirements for maintaining a minimum amount of capital relative to risk assets. The capital adequacy ratio, which measures Tier 1 and Tier 2 capital against all risk-weighted assets, is a critical measure monitored by regulators. Liquidity risk. Liquidity risk arises primarily from the maturity transformation function performed by banks. If confidence in a bank is shaken, resulting in a series of loan losses, it can lead to a liquidity crisis. This loss of liquidity often triggers bank collapses. To mitigate potential liquidity issues, banks maintain sufficient liquid assets on their balance sheets. Regulatory bodies typically impose minimum requirements for these assets. Banks also rely on maturing assets and wholesale market access to enhance liquidity. Metrics such as the customer loans to deposits ratio and the number of days a bank could survive without rolling over positions at maturity are used to assess liquidity. Interest rate risk. Interest rate risk stems from fluctuations in the yield curve. This risk primarily affects a bank's earnings, specifically the net interest margin, which greatly contributes to profitability. Structural risk, driven by the difference between rate-sensitive assets and liabilities across various repricing periods, constitutes the main interest rate risk for banks. Additionally, market risk, arising from the fluctuation in the value of fixed-rate securities, is another significant source of interest rate risk. ALM also encompasses other critical risks, such as concentration risk, settlement risk, securitization risk, and pension risk. Basel II Pillar 2 requires banks to identify, analyze, and stress test these risks, ensuring adequate capital support, as per regulatory satisfaction. Lastly, a bank's credit rating affects various key areas, including the cost of wholesale funds and the types and amounts of business that wholesale and corporate counterparties are willing to transact with the bank. Maintaining a strong credit rating is essential for bank success and credibility. Want to learn more? Claire Trithel on LinkedIn. The Basel Accords. A comprehensive overview for banking professionals. Understanding the intricacies of financial regulation is essential for banking professionals. Among the multitude of frameworks that shape the landscape of global banking, the Basel Accords stand as an indispensable guideline. Historical background. The genesis of Basel Accords. The Basel Accords originated from the Basel Committee on Banking Supervision, BCBS, established in 1974. Following the collapse of Bankhaus Herstatt in West Germany, the committee was formed to address the repercussions on the international financial system. Originally composed of G10 countries, the committee has since expanded its network to include 45 institutions across 28 jurisdictions. With regular meetings throughout the year, the committee continually evolves and strengthens the regulatory environment for international banking. Basel I, the onset of risk-based capital requirements. Introduced in 1988, Basel I, officially known as the Basel Capital Accord, aimed to standardize capital adequacy requirements. It mandated banks to hold a minimum of 8% in risk-weighted assets, addressing concerns about capital ratios in the global banking system. Over time, amendments were made to Basel I to include provisions for loan losses and encompass not only credit risks, but also monetary risks. Basel II, an enhanced framework. Basel II, implemented in 2004, succeeded the 1988 Accord. Building upon its predecessor, Basel II introduced new dimensions, such as an internal assessment process and increased cooperation between home and host supervisors. These enhancements aim to bolster market discipline and enhance banking practices. Basel II expanded the scope of capital requirements, allowing for more granular risk management strategies. Basel III, addressing systemic inefficiencies. Basel III, introduced in response to the 2008 financial crisis, addressed not only the crisis, but also underlying systemic inefficiencies and governance failures. Revisions made in November and December of 2010 focused on the quality and quantity of common equity. The minimum requirements for common equity were raised from 2% to 4.5% of risk-weighted assets, accompanied by a capital conservation buffer of 2.5%. Additionally, Basel III introduced a leverage ratio to enhance the overall resilience of the banking system. Supplemental features and continuing evolution. Basel III brought liquidity risks to the forefront of regulatory concerns with its framework for monitoring liquidity. The Basel Committee has continually updated its principles, with the most recent update outlining 29 principles in September 2012. For banking professionals, understanding the Basel Accords is crucial for navigating the regulatory landscape. Stay informed and up to date on these guidelines to ensure compliance and proactive risk management. Want to learn more? Claire Trithel on LinkedIn. Capital dynamics in banking. Navigating the nuances. In the intricate financial tapestry of banking, capital serves as the sturdy thread binding the system together. For any banking professional, a nuanced understanding of capital management is not just beneficial. It's essential. Today, we'll take a deep dive into the multifaceted realm of banking capital, exploring its various dimensions for a holistic view. The foundation: capital as a buffer. Imagine capital as the safety net of the banking world, ready to absorb the shocks of unpredictable events. Whether it's credit mishaps, market downturns, or operational mishaps, capital rises to the occasion, ensuring depositors and creditors are insulated. This forms the bedrock of trust in the financial world. Common Equity Tier 1, CET1, capital, the gold standard. CET1 capital, primarily constituted of ordinary shares and retained earnings, is the pivotal component of banking capital. Its enduring nature ensures it remains a constant within the bank, with the capacity to absorb losses without jeopardizing the institution's solvency. It acts as a shield during turbulent times. Regulatory versus accounting definitions. The definition of capital varies between regulatory and accounting spheres due to their different focuses. Regulatory frameworks prioritize stability and depositor protection, emphasizing capital's loss-absorbing capacity. Accounting definitions, on the other hand, strive to present authentic financial positions to investors. This occasionally results in instruments deemed capital in accounting, but falling short in a regulatory context. Nuances of capital in crisis phases. During a bank's life cycle, we encounter the nuances between going concern and gone concern capital. Going concern capital, like CET1, operates when the bank is operational and deflects insolvency threats. Gone concern capital, on the other hand, ensures seamless resolutions during catastrophic downturns without burdening public finances. The dance between leverage and return on equity, ROE. The interplay between leverage and return on equity, ROE, provides a fascinating insight. Balancing risk and reward, an increased leverage scenario can double ROE, but it comes with heightened risks. It underscores the delicate balance within the banking ecosystem. Regulatory and economic capital, distinguishing notions. To conclude our exploration, it's important to distinguish regulatory and economic capital. Regulatory capital focuses on prudent capital requirements for stability, while economic capital aligns with the bank's risk appetite and profitability goals. Want to learn more? Claire Trifle on LinkedIn.
Join the Global Banking Hub today and unlock an extensive library of Treasury video courses with new content added every month to keep you up to date on the latest industry standards and practices. Whether you're looking to deepen your understanding of interest rate risk management, liquidity coverage ratios, or Basel III compliance, our expert courses are designed to give you the skills and knowledge you need to excel. Each course comes with a practical certification opportunity, allowing you to demonstrate your expertise and advance your career with feedback from a senior Treasury professional. As a member, you'll also receive our weekly global banking update reports, packed with actionable insights on global banking trends, regulatory changes, and market movements, giving you the tools to apply the latest developments to your organization's strategic decisions. Finally, our in-depth how-to guides provide step-by-step solutions to complex Treasury challenges, from calculating liquidity ratios to managing non-maturity deposits. These practical guides ensure you're equipped to tackle the real-world issues that matter most to your role. Become a member today.
Since joining the Global Banking Hub, my career has completely transformed. I was recently promoted, and a big part of that success is thanks to the knowledge and insights I've gained from the Hub. Suddenly, I became the go-to person in the office for up-to-date banking news and how global events would impact our strategic decisions. I'm constantly complimented on my ability to anticipate market changes and offer solutions that align with our bank's goals. The weekly reports and in-depth courses have sharpened my strategic thinking and given me the confidence to contribute at a higher level. People started noticing the change almost immediately. My boss, my team, everyone. The Global Banking Hub has genuinely given me the tools to elevate my career. Join as a member of the Global Banking Hub today and gain the knowledge, insights, and confidence to stand out and lead in your organization. Your promotion could be just a step away.